Good evening, everyone. Thank you for joining our webinar tonight on finding opportunities in a yield-starved environment. Our fixed income manager, Mr. Chung will first begin by sharing an introduction on Bondsupermart, our research coverage and methodology, followed by sharing on his thoughts about the fixed income outlook for the second half of the year. He'll introduce our second half 2020 recommended bonds report before passing his time on to our panel of analysts from Singapore, Hong Kong, and Malaysia, who will then speak about their personal favorite bonds. So stay tuned for that. Without further ado, I will pass my time on to Chung to begin his segment.
Thank you, Sarah, and good evening, everyone. My name is Chung. I'm from the research team of Bondsupermart, and I look at mostly high yield and non-performing issuers in the Sing dollar space. On behalf of the team, thank you for joining tonight's webinar, and I hope everyone is safe and well. If you have been invested in the financial markets, you know that the first half of this year has been a roller coaster ride. Our agenda tonight is to review what happened thus far and what that means for the rest of 2020. Before that, I want to introduce you to Bondsupermart and what is it that we're trying to achieve. I will also let my fellow presenters talk about some of their favorite bond ideas. So I'll start with an introduction to Bondsupermart. To put it simply, we are an information and fintech solutions provider for all things related to bonds. We are the first in the industry to make bond information and pricing freely available to the public. We are not a broker, but we can support what we do by putting in your bond trades with one of our affiliated partners. Besides bond information, we have also developed various tools to help users analyze their bond investments, and our team of analysts write research reports on a wide range of issuers. This slide shows a sample of the bond fact sheets available on our website. One of our goals is to be the information portal of choice for bond investors, and our fact sheets provide a comprehensive range of data, including bond pricing, important bond features, and credit ratings. If you don't have a particular bond in mind, our website allows you to do a search based on the criteria you set. Like for instance, you can filter for US dollar bonds maturing within 5 years, listed in Singapore, and have at least investment grade credit ratings. After you have shortlisted a few bonds, you can use the calculator tool on our website to work out the return that you will be getting based on the price that you key in, and the payment amount including accrued interest. If you're interested to know more about recent market trends like interest rate movements and the yields in different markets, you can use our charting tools to build a customized chart according to your needs. All these tools I mentioned are available to everyone without the need for a login. But if you register for a free account, you'll get access to additional features like building your own watch list and tracking the bonds of your interest. If you want to know our opinion about a particular bond before investing in it, you can go to the articles section of Bondsupermart, where we publish weekly market newsletters, regular credit updates, and bond recommendations. Because we are based in Asia and also we think Asian bond markets are more inefficient, our fixed income research coverage is primarily focused on Asia. We have 8 analysts across our offices in Hong Kong, Singapore, and Malaysia, and 4 of us, including myself, are here today for this webinar. We cover mainly bonds denominated in USD, SGD, HKD, and Ringgit across a wide range of sectors like real estate, banking, and retail. One of the frequently asked questions to us is how do we select the bonds that we like and recommend to investors? Obviously, fixed income research is a huge topic that's impossible for me to talk in detail over a single session. But I'll try to summarize the main elements of our approach. We usually start with a credit analysis of the issuer, which have 2 components. One is the company's financials and the other is its business. And it's typically better to start looking at the industry first because you need the qualitative context before you are able to understand the numbers. Different industries will have different factors to look at, but some of the more common ones that we usually evaluate include the cyclicality of the business, the growth prospects of the market, and the level of competition in the sector. Then we look at the financial aspect, like how much debt the company has, how liquid is the balance sheet, how good is the profitability, etc. After that, we look at valuation. Just like when you invest in stocks, a company can be profitable and fast growing, but if the share price is overvalued, then it might not be a good investment. It is the same for bonds. Sometimes a highly risky bond can be a good investment if you have the ability to diversify a portfolio and your risk tolerance allows. We combine our credit analysis and bond valuation, then we'll have an opinion of whether a particular bond is attractive or not. From there, we'll work out a list of recommended bonds that ideally is a good mix of high quality bonds as well as bonds that are more speculative. Next, I'll share some of my thinking about what is happening in the market and the implications for our portfolio. I think the background should be well known to most, if not all of you. Early in the year, global markets were continuing their upward climb after the US and China signed a Phase 1 trade deal in mid-January. Then investors began to price in COVID-19, sending the market down its fastest trip ever into bear territory. Global markets reached their low on the 23rd of March, the day when the US Fed announced a massive monetary stimulus program. Following that, risk assets started their biggest rally ever, recovering at least half of their losses very quickly. And certain sectors of the market, like investment-grade corporate bonds, Nasdaq 100, have even exceeded their pre-virus levels. Risk assets have continued to climb in July, even with concerns over rising infection case growth in a number of countries. One interesting observation is that gold has been one of the top performing asset class this year. My own guess is that earlier in the year, people have been buying gold to hedge against the high uncertainty from COVID-19. Then when prices surged, more investors probably came in to chase the momentum and also to seek the diversification benefit of gold because interest rates are extremely low. There are many possible reasons for the great market rally since March. Firstly, the major government actions in terms of monetary and fiscal stimulus have been an enormous contributor, boosting market sentiment and financial conditions. As you can see on the right here, financial conditions improved very quickly across the world from the brief tightening in February and March. The left chart shows the rapid growth of major central banks' balance sheet as they are used to finance the government's fiscal measures. Now, although I agree with the consensus that quick and decisive government actions are needed in this crisis, I'm also concerned with the possible side effects from ballooning government deficits and debts. For instance, US government debt is now more than 80% of the country's GDP, and Fitch recently downgraded its credit rating outlook to negative. Another factor supporting the market is the widely held expectation that interest rates will be lower for longer. With major central banks like the Fed already stated that they will keep rates low through at least next year and possibly 2022. This is a good thing for bond investors. But one thing to note is that with most sovereign yields approaching zero, I think the hedging benefits are becoming increasingly limited. So even conservative investors should think about diversifying away from developed market government bonds toward other alternatives. Just now I mentioned that financial conditions have improved a lot since March. If you combine that with explicit support from the Fed for corporate bonds, then we've seen a record level of bond issuance in the US, with most deals heavily oversubscribed. Although this is good for the market in the short run, because even money-losing companies will be able to refinance and stay alive. Again, the longer-term ramifications are harder to tell, because in previous crises, we typically see a deleveraging in the corporate world, but this time round, the opposite is likely to happen, and we might have a case of lenders willingly financing zombie companies and rising defaults down the road. On the Asia side, things are looking a lot more reasonable, with the issuance volume only seeing a strong rebound in the last couple of months. Here I use offshore Chinese bond issuance as a proxy, as they make up the biggest part of the Asian bond market. And back in Singapore, things are a lot more quieter. SGD new issue volume fell by close to 40% in the first half of this year. This chart on the right shows the breakdown in issue quality based on Bondsupermart's classification, as the SGD market is mostly unrated. And most of the 17% of new high-yield bonds were actually launched before COVID-19, with only 4 high-yield bonds issued after February. The biggest issue size was just 65 million. That tells us possibly two things, one good and one bad. First, SGD investors are still highly risk-averse, which is usually good for valuation and prospective returns, because when most people are scared, investments are usually cheap. Second, the number of high-yield SGD bonds continue to become lesser, which is bad, as it will be more and more difficult for us to find good high-yield choices in the SGD space. In terms of fundamentals, I think we all know that most economies shrunk in the first quarter and most likely the second quarter as well, except for a handful of countries like China that's benefiting from the first in, first out effect. Our own Singapore recently reported a record-breaking 41% drop in GDP, officially going into recession. If you think about it, the world is fighting the greatest pandemic as well as the worst economic downturn in our generation. But financial markets are close to where they were before the crisis hit, when the economy was still looking good. How is that possible? There are a number of frequently cited reasons for this disconnect, and I'll talk briefly about some of them here. One major argument supporting the great rally is that the market is always forward-looking, and the consensus out there is the global economy will see a recovery starting in the second half. Most experts are now just debating about whether the recovery will be V-shaped or S-shaped. I agree with this consensus, but I do have some concerns about the trajectory and the speed of this recovery, which I'll talk more about later. Another factor frequently cited by optimists is that the market rally has been spearheaded by the tech sector, which is supposed to be shielded from the crisis and might even benefit from it. But I find it difficult to grasp how tech can continue to grow at the pace that the market expects it to, when at the same time the rest of the world is coping with deep recession. And recent relative returns between tech stocks and the rest of the market have reached a level not seen since the dot-com bubble. So I think there are some grounds for caution. One more potential factor that could have supported risk assets is the record number of retail investors going into the stock market. Because of lockdown measures forcing people to stay at home, free money from the government, and low trading costs, retail investor participation has surged to a high level in the first half. So far, this growth of small investors has outperformed professional managers by buying the beaten up stocks in the riskiest companies, which were done by institutional investors in the February to March sell-off. But the ending of this story is harder to tell. And if some of the most prominent retail investors think they are better than Warren Buffett because of just a few months of success, I think it is a sign that the level of excitement in financial markets is becoming a problem. So what are the potential factors that could spoil the party? I think the number one concern these days is the possibility of a second wave of COVID-19. And we have seen that, for instance, in Hong Kong recently, where the government was forced to reimpose restrictions after a spike in infection cases. My own view is that governments are unlikely to go back to their strictest lockdown measures, even if there's a second wave. Now that we have seen the devastating economic impact of such measures, and also the world should be better equipped to cope with this health crisis now. But regardless of government policy, if the population is worried about the virus and hence avoiding shopping malls and restaurants, then the economy will still suffer, whether there's lockdown or not. The second downside risk to the global economy is the risk of a bumpy road to recovery. Here we look at China and the US as case studies. Although China has rebounded strongly in the second quarter, we need to note that much of the country's momentum was coming from state-driven industrial activity, while consumer spending has remained weak, as shown on the left here. For the US, after substantial improvements in May and June, the number of people filing for unemployment benefits has stayed at roughly the same level in recent weeks and way above previous crises. If consumer sentiment stays weak in these two countries, global recovery is likely to be slow and uneven. Globally, we are also seeing higher levels of financial insecurity among consumers. These two images are taken from a YouGov survey across 26 countries and reported by Bloomberg. Broadly speaking, this survey tells us that households everywhere are now more concerned about their jobs and their financial situation. Many people will cut non-essential spending and invest less, and that could slow the economic recovery. Finally, we are also seeing the re-emergence of geopolitical risks as virus concerns fade. Like for instance, the deteriorating US-China relations, North Korea conflict, and the rise in populism and nationalism. These events add to the tail risks facing financial markets. Overall, weighing all these factors, including what I said, the recent performance of the market, valuations, and the economy, I agree with the consensus that the fundamental outlook is positive on balance. But what I disagree with is the valuation of most risk assets, because I think the overall investor attitude today is somewhat too relaxed, and valuations have not sufficiently priced in tail end risk. So we should be more defensive in our portfolio allocation. Having said that, being defensive does not mean we should avoid the market altogether. Instead, we should focus on valuations and insist on reasonable risk return. And at the moment, a number of asset classes are still deeply discounted both relative to history and other sectors, like for example, Eurozone equities and Asian bonds. This slide shows the valuation of Asian bonds versus their US counterpart. Even after the recent rebound, Asian corporate bonds still offer attractive spreads that are much higher than the historical average, especially Asian high yield, as their premium over investment grade is more than one standard deviation above historical mean. On the other hand, I think US IG is a bad place to be in. Although they enjoy the support from Fed, their current risk premium is actually lower than the long-term average, which is as if the virus never happened. So I think the market is putting too low a probability of rising defaults in the US. This chart on the left here illustrates the sizable spread pickups that Asian bonds offer over other fixed income sectors like the US and Europe. Although some near-term weaknesses are expected given the economic damage from the virus, it is important for us to have a long investment horizon and invest when yields are attractive. This is because yields have historically been a reliable predictor of the eventual return from bond portfolio. This right chart shows yields at the start of 5-year periods in the past and the subsequent total returns 5 years later. Basically, what it tells us is that if you invest in a diversified bond portfolio yielding 5%, you should get around 5% return over the following years. But of course, the caveat is that your portfolio needs to be well diversified. Besides attractive valuation, the credit metrics of Asian issuers are decent compared to their peers. As you can see from the left chart, Asian high-yield issuers have financial leverage that is on the lower end of the spectrum versus other fixed income segments. And on the right, we see that the average gearing of Chinese developers is on a downtrend in recent years, although the median number is rising. Most likely what this tells us is that the financial health of highly leveraged developers is improving, which is good for the high-yield sector. Just to quickly sum up this section, my opinion is that overall the market environment today is on a relaxed end, and the valuations of risk assets do not sufficiently compensate for the risk of disappointments in the economy and corporate earnings. Nonetheless, there are still asset classes that are offering attractive valuation, like Asian bonds and especially Asian high yield. But because of my caution toward the market environment, I think credit selection is now more important than ever, meaning you should take more care in choosing your investments and making sure the risk return is appropriate. I've come to the end of my section. My colleagues will take over from here to talk about some of their favorite bond ideas. I think I'll start my Malaysian colleague, Ganageaswaran.
Okay, thank you, Chungi. So my name is Ganageaswaran. I sit on the fixed income desk in Malaysia. So today I'll be presenting two of my favorite bonds. One's a USD note and the other's a Ringgit Sukuk. So without further ado, without wasting anyone's time, let me get started. So what I'll do today is, obviously I've broken it down to two sections. The first section is precious metal and the second section is matrix. So I'll walk you through what the business profile is. I'll touch briefly on the aluminum business. I'll talk about why I like this bond, why I like this business, why I like precious metal in terms of their competitive advantage, how they are a profitable business. I'll talk about their recent tender offer. And then at the very end, I'll talk about if a potential investor comes in right now, how much is he or her going to make? So I'll do the same for Matrix as well. So without further ado, precious metal is our recommended bond. So it's a 4.8% coupon that will be maturing in 30th October 2022, and it's a USD note. So who is precious metal? So precious metal is a business that is involved in the aluminum smelting and extrusion business. It was founded by the Kuhn family. It is led by Tan Sri Po right now as the CEO. It's owned 60% by the Kuhn family collectively. It is one of the 30 component stock indexes of our KLCI index with a market cap of 20.15 billion. So precious metals actually is the biggest aluminum producer in Southeast Asia. The next big aluminum producer is actually in Indonesia, and they're actually 3 times smaller. So that shows you the size of precious metal as a business. So briefly touching upon the aluminum business. So latest available data as of 2018. So since 2016, the demand has exceeded supply for aluminum, and most of the demand has come from the transportation and construction industry, making it more than half of the demand for aluminum. So since 2019, mostly escalated by the US and China trade war, it has pressed down prices of aluminum, and it's not helped by the fact that we are actually going through a pandemic. So despite being in a sector which is not that favorable, there's a reason why I still like precious metal. And these are the 3 main reasons. So the first competitive advantage of precious metal is it has an integrated supply chain. So what this means is for aluminum to be produced, they need 3 major inputs, which is alumina, carbon, and electricity. So what precious metal has done over the years is they have either gone to do a JV, a joint venture, or they have actually bought smaller players across the region to source the supply of alumina and carbon. So in that sense, they don't have a disrupted supply, and in the same sense, they can also reduce their cost of goods sold. Other than that, they also have favorable power rates. They are actually Sarawak Energy's biggest customer. By virtue of being their biggest customer, they have signed 15 to 25 years PPAs, energy contract rates. So they get a heavy discount on the electricity. So what this all means is by having a low cost, it's easier to be profitable. And you add the fact that they get a lower tax rate, and the reason for their lower tax rate is the fact it's because they have a pioneer status, which entails them to get a lower tax rate until 2027. So you have low cost and you have a lower tax rate, so it's easier to make money and to remain profitable. And I'll tell you why this matters. So I've pulled up data for the past 10 quarters, as you can see. Why I said it's a big deal is because about 50% of world aluminum producers are operating at a loss, according to data by RAM. While Q1 2002 has not been Pressmetal's best showing, it's actually one of the lowest net profit at 100 million ringgit. And you've got to bear in mind, this was also during the lockdown. Being profitable is on its own it's already a big deal for Pressmetal, given the fact that 50% of the aluminum producers around the world are operating at a loss. And from what I've gathered recently, some of them has already closed out. So that will balance back the equilibrium of supply in the market. So most of this, as I pointed out earlier, this net profit being profitable is coming from their cost advantage. So briefly speaking about the tender offer, so what has happened recently is Pressmetal has gone out to buy about 173 million of their bonds outstanding from the 400 million that they've offered previously. So the rationale for this is they have some cash lying around, and they thought that, okay, since we are in a lower interest rate environment, I'm going to buy back some of my bonds back so that I can reduce my interest rate. So again, just to reiterate, they have a lower cost structure, they have lower tax rate, and now they're doing the smart thing of lowering the interest borrowing cost. So you can only imagine that this net profit will only become more and more as we go further. So if you like this company like I do, and you want to get invested at this point, right now the offer price is at about 96. So what this means is if you enter at 96 right now, your effective yield to maturity will be 6.77% yield to maturity, which represents about a 664 basis points spread. So that is all. So just to wrap up for Pressmetal, low cost structure. It's managed by a family that has been in the business for a long time. It is actually the biggest aluminum producer in Southeast Asia that is also profitable and doing the smart thing of managing the balance sheet efficiently. So that's all for Pressmetal. Moving on to my second favorite bond is Matrix Concepts 3-year sukuk that gives about a 5.5% coupon, which will be maturing in 2023. So who's Matrix Concepts? Matrix Concepts, for you guys who have not heard of them, they are a property developer in Malaysia. They're most famous for their projects in Bandar Seri Sendayan in Seremban. They have a market cap of about 1.44 billion, and they are close to 10% owned by EPF. So for most of our overseas investors who sit in Singapore and Hong Kong who don't know what EPF is actually our largest pension fund. So investors can take comfort in the fact that this is a company that's about 10% owned by our largest pension fund. So being in the property development, most of the questions that are directed to me is, okay, so what do you think about the property overhang in Malaysia? It's no secret that a lot of houses it's unable to be sold. There's a property overhang problem, not just here, but given that Matrix operates in Malaysia. So what I've done is I've pulled the latest data from NAPIC. So what this chart shows is the completed residential property overhang. So how do you read this? How do you read this chart? It's defined as a residential property overhang is defined as a property that has been built for 9 months, but they still can't sell. So the way to read this chart is, as you see on your far left, a property that is valued as less than 100,000 has a 21.4% property overhang. So for every 100 houses that are built in the less than 100,000 ringgit segment, 21 houses are unable to be sold. So obviously you can see from the chart, the biggest problem comes from the 900,000 to 1 million ringgit. About 37 out of 100 houses are struggling to be sold. Now, if I can bring your attention to the far right, obviously Matrix Concepts operates on different segments of the market, but as a whole, Matrix Concepts only have a 3.35% property overhang. So meaning to say, for every property that they've built over 9 months, 97 houses out of 100 houses gets sold. So is there a problem? Yeah, in Malaysia as a whole, yes. But is there a problem with this particular property developer? I don't think so. So what are their competitive advantage? One is they have a very, very low land cost. So based on latest available financial data, they have a land cost of less than 10 ringgit per square feet. So anyone who has ever bought a property in Malaysia will know that 10 ringgit per square feet is absolutely dirt cheap. There's absolutely nothing at all. So given the fact that they have this competitive advantage, it's easier for them to make money, and it will show up as a net profit in their income statement. Other than that, they have sufficient land bank. So they have close to 2,000 acres of land on their books. So why does this matter? I mean, if say they can't sell their houses, they can't pay, they have cash flow problems, they can't pay their bond. They have 2,000 acres worth of land that is valued about 10 billion ringgit that they can auction off to pay off the bond. And as I've mentioned previously, they have a low inventory. So Matrix Concepts' competitive advantage lies in these three things: a low land cost, sufficient land bank, and low inventory. So how does this competitive advantage show up on their financial statements? So Matrix Concepts has a superior profitability and balance sheet. So what I've done here is I've compared them against major developers in Malaysia, like as we sit here, UEM, Sunrise, Eco World, and Masing. So the operating margin, as you can see, I've also pulled out the industry average. The industry average operating margin in Malaysia for a property developer is about 15%. And if you compare that to Matrix Concepts, it's almost double at 30%. So like I said, having a low land cost, having a sufficient land bank, all of this will show up, and it's showing up here as a double the operating margin compared to the industry average. Besides that, they have very, very low gearing, almost half of the industry average. The industry average is close to 40%, and they have about 20% in terms of debt compared to the equity that they have in the books, which is very, very impressive because you have a very good profitable business, and then on the same hand, you have very low debt. So the chances of you repaying your bondholders is very, very high. So this is what makes this business very, very impressive and why I like them as a whole. So this is some of their recent operational highlights. So for our overseas investors who don't know what MCO is, MCO stands for a Movement Control Order. Basically, simply said, it's a lockdown. So our economy was locked down for two months plus. But even in these 2 months where people can't go out to showrooms, they can't leave their house. Despite not being able to leave their house, Matrix Concepts residential bookings jumped by 45%. So for a company to be able to book this kind of bookings, there's only one thing that you can rely on, which is your brand name. So given the fact that they have had bookings jumped by 45%, tells a story on its own. So one might argue, okay, fine, your bookings have jumped, but does that mean it will show up in your revenue? So on your right-hand side, you can see this is as of last Friday. They have Matrix Concept have announced their latest earnings, and they have clocked in the highest earnings on a record revenue since forever. So as a whole, as I've pointed out, this is a company that's very well managed. They have strong cash flows. They have good profitabilities, very well balanced, a balance sheet that's very well managed, and it's showing up even in the middle of a pandemic. So if you get invested right now in Matrix Concept, you would enter at a price of 102, and you see a yield to maturity of 4.65%, which is very, very generous. In Malaysia, it's close to double of your fixed deposit rate. Obviously, this is not a substitute to your fixed deposit rate. It comes with certain risks, but as I pointed out, this is a very well managed business. So personally speaking, this is where we can present whatever we want, but if you don't have skin in the game, it doesn't matter. So this is where I want to tell everyone that as much as I like this bond, I've actually bought it personally for myself. I've used this personally for my own portfolio to substitute my fixed deposit, not just for myself. I've also bought this for my mother, and my mom's a retiree, so obviously I have to do extra due diligence to take her money away from fixed deposit. And anyone who knows to taking their mother's money is not the easiest thing in the world. So not only have I convinced myself, my mom, I've also convinced my investment team. Some of them have used this as a cash alternative. So with that, I end my presentation, and I'll pass this over to my colleague over in Hong Kong, Jackson.
Okay, so can you hear me? Okay, so thank you, Ganageas. So I'm Jackson. Good evening, everyone. I'm Jackson, the Hong Kong fixed income analyst from Bondsupermart. So I mainly specialize in the Chinese real estate sector. So today I am quite happy to be here to give some of my bond investment ideas on the sector as well. First of all, I will walk you through the sector about the Chinese real estate market. First, for people who do not have much knowledge about this sector, you may need to know that when we talk about Asian high yield bond, the Chinese real estate sector are one of the most popular sectors that bond investors would like to put their money into. So the market itself is very big. With the total outstanding value of this real estate related USD bonds is at about 220 billion USD level. So as of June this year, so it is easily the largest single sector in terms of total issuance amount. With the huge size of bond issuance, we can find different bonds across almost every credit rating, yielding from 2% to over 15%, which could be suitable for almost every investor who has different risk appetite and investment horizons. And generally, we saw that the yields on these real estate bonds are usually better than the other sectors. With more than 100 issuers in this sector, we do believe there is a lot of opportunities right here. So after the brief introduction, let's go into the specific bonds that I would like to talk about today. And the first one is China Evergrande. So China Evergrande is the largest Chinese developer in terms of contracted sales in China. So Evergrande has experienced a decline in its earnings in 2019 as a result of the pressured profit margins from previous price cuts. At the same time, the credit matrix are also worsened with a net gearing ratio exceeding 180%. But in terms of cash flows, Evergrande has generated a strong cash collection during the pandemic. It is actually one of the fastest growing first-tier developers in China, despite the industry is negatively affected by COVID-19. So its contracted sales increased by 28% year on year to over 410 billion RMB in the first 7 months in 2020. So we expect the liquidity is supported by the sales return, as well as some recent refinancing. So the group has the largest land bank among all developers, which these tangible assets will serve as a strong backup for the group's future development and refinancing. We expect the total sellable resources for the group will still be over 2 trillion RMB, which is adequate to support the sales in the next 4 to 5 years. So the group claimed that it will officially enter the era of deleveraging and reducing its land bank, which is serving as a positive signal for bondholders. So Evergrande bonds are one of the most heavily traded bonds in the market. With its current credit rating at single B level, its bonds are now yielding at 10% to 13% level. So we think they are attractive now, and investors can consider the shorter term bonds, such as the March 2020 bond. And we think it should be the optimal strategy to invest into this kind of highly leveraged issuers. So if you are interested, the current bond yield of this 2020 bond, 2022 bond is at about 11%, and the price is at about $96. So the next one I'm going to talk about is Country Garden. So similar to Evergrande, Country Garden is another top developer. So we saw that the group sales performance hit a record high last year. In 2020, the attributable contracted sales from Country Garden declined by about 1% year on year to 320 billion RMB in first 7 months, which is actually in line with the industry average. So on the other hand, we noticed that the group also continued to maintain a strong cash collection capability, as well as a decent credit profile. As at the end of 2019, the Country Garden net gearing ratio is at about 56%, far below the industry average, and even better than the median of triple graded issuers. In addition, the cash on hand for the group is ample, with the cash to short-term debt ratio at around 2 times, reflecting a strong liquidity position. It gets even better after the issuance of several new bonds this year, and the maturity periods are also favorable with 5 years or above, further improving the overall debt structure. On the other hand, we estimated we estimated that the value of sellable resources increased by about 30 billion RMB to a total of 1.7 trillion RMB. So this huge amount of land will continue to support the group sales in the upcoming 3 to 4 years. So we believe that the large size developers will remain dominant in the coming years. With Country Garden's current size and leverage level, its healthy liquidity and credit status will be strong enough to withstand the impact brought by the market uncertainty, such as the COVID-19 and the regulation control from the government. Country Garden's bonds, which are somehow borderline investment grade right now, the bonds yield are now at around 3% to 5% level. And we think it is attractive for investors who are looking for stable income with manageable risk. So since Country Garden has a better credit relative to Evergrande, we think investors can also consider the bonds with longer tenor, such as the January 2025 bond. So if you want more information about it, currently the bond yield is at 4.2% with a price at about $103.5. So that's the end of my part. I'm going to hand over to my teammate, Kiki.
Okay, so thank you, Jackson. So I'm Kiki from Hong Kong Fixed Income team. So actually, Hong Kong Fixed Income team is mainly focused on Chinese property issuers. So my teammate Jackson has mentioned he covers Chinese property developer. So and I take care of other Chinese corporates from different sectors such as banks, conglomerates, and utilities. So for me, I think I'm actually a risk-averse person. So for my own bond investments, I like bonds that can give me yield to maturity about 4 to 5%. And so here are two names I'm going to recommend, Foxton International and Lenovo Group. Okay, so next page. Yes, so for Foxton International, it is a Chinese international conglomerate and investment company. So it is a large-scale integrated private enterprise group, and it has many businesses across different areas such as healthcare, consumer goods and services, insurance and investment, and so on. So the group has three primary business lines. They are health, happiness, and wealth. So business performance, the company's revenues and net profit will continue to grow in 2019. As you can see from the graph on the right-hand side, these 5 companies contribute most revenues under the group of Fosun. So in 2019, the company's revenue reached 143 billion with 31% growth year-on-year. And the profit was increased by 10% year-on-year to 14.8 billion. So it is the 8th consecutive year of growth. So what we think is the company's operating performance is generally good. And for credit part, what we think is its credit condition is largely stable. So you can say Fosun's net gearing, the gearing ratio of Fosun was around 53% in the last 2 years. So from the graph, you can see the gearing ratio is keeping stable for some years. And the group's average cost of debt was about 5%, and the net the interest expense are manageable. And also, its cash position is enough to cover its short-term debt, and together with its sufficient bank credit facilities, the overall credit profile of the group is acceptable. All right, so come to the bond investment. So you can see there are currently 6 Fosun International USD bond here, and the yield maturities of the bond are ranging from 3.5% to 5.8%. And the bond credit rating is S&P BB grade, so it is considered as a non-investment grade bond. So among them, I like to choose Fosun 2022 bond. Its yield maturity is about 5.149%, and the remaining investment period is less than 2 years. As you know, the yield to maturity of the longer term bonds, such as 2023 or 2024 for some bond, actually the yield to maturity are just slightly higher than that of 2022. So the short-term bonds needs to face relatively less uncertainty. So this is the reasons I think for some 2022 bond is a better choice. All right. Yes, next page. And next one, it is the second one I'm gonna choose will be Lenovo bonds. And I think we all know Lenovo Group is currently the largest PC vendor in the world. And a recent Ghana report shows Lenovo shipped 16.2 million PC in the second quarter of 2020, and it secured 25% of the market share. So the company remains the leader in the PC segment. And actually, the Lenovo business can be divided into two major segments, where the PC and smart devices, so the short form is PCSD, remain the biggest earnings contributor with nearly 80% of the group's total revenue. And here, the business performance of Lenovo are good also. You can see in the fiscal year of 2019 to 2020, Lenovo recorded a total revenue of 51 billion, and there is just a very slight decline year on year. And during the fiscal year, Lenovo actually achieved a record-breaking performance, with its pre-tax profits increased nearly 20% year on year to 1 billion. And this shows the company actually has a really strong profit growth. And then, yes, here is the credit part. So in March, Lenovo's net debt was reduced by 25% year on year to 1.2 billion. As you can see from the graph here, the amount of net debt is moving downward, and the company's net gearing ratio remains at a healthy level of 30.6%. So according to is a nice interest coverage ratio and sufficient cash balance, the company is in a comfortable liquidity position. So overall, the credit matrix of the group is quite good. And yes, here's the bond investment part. So here you can see there are currently 3 Lenovo USD bonds, and the yield to maturity of those bonds are ranging from 2.6% to 3.9%. And we see a good value are in 2025 bond, yes, Lenovo's one, and it offers a yield to maturity of 3.855%, and the remaining investment period is about 5 years. So with a sizable yield premiums, it is so obvious that the Lenovo bonds are more attractive than its peers, such as Dwells and HPE. So you can see the table in the right-hand side. You can see actually the yields that Lenovo can offer is a lot higher than that of the peers. And yes, so overall, what I want to say is both Fosun International and Lenovo Group are considered as good names in corporate bond investment. So together with their strong financing capacity, my view towards these bonds is quite positive. Yes. So this is my sharing. So now I will pass it to my colleague Lynda to share her ideas with you guys.
Thank you, Kiki, and hello everyone. I'm Lynda from Bondsupermart, Singapore, and I mostly covers the Singapore and Asia Pacific real estates. Outside of properties, I also research on airlines, local conglomerates, and food and beverage in selection for mostly perceived safer credits. I'm likewise, as Kiki does, a risk-averse investor and sees fixed income as a good instrument for diversification purposes within the portfolio. So today I have here 2 bonds to share, one from Fraser & Neave Limited and one from Metro Holdings. Let me begin with Fraser & Neave Limited, FNN. FNN is a beverages manufacturer producing household drinks such as the 100 Plus, Nutrisoy, and FNNT series. The beverage producer is listed on the main board of SGX with a market cap of about 2 billion and is majorly owned by a rich Thai family. In the very much various bitter economic conditions these days, we like FNN's credits because it operates in essential services sector, which helps to shelter from the COVID-19 impact. And at the same time, FNN has a strong credit profile generating positive cash flows that helps to meet debt obligations and business expansions. FNN operates in 3 business segments, namely dairies, printing and publishing, and beverages. And as seen here, most of its revenue comes from dairy segment, which has been mostly on a stable trend. It is also widely geographically diversified. Most of its products are sold in Malaysia and Thailand, as well as Singapore. The company displays a solid capability of servicing interest payments, as operating earnings shown by the blue bar here is always more than sufficient to cover interest expenses, shown by the red bar here. More importantly, the company has a positive operating cash flow trend of about 200 million per year. Meanwhile, there's also ample liquidity, as seen in the on the chart on the right here. It has about 249.2 million of cash on hand, well exceeding short-term debt obligations of just 19.5 million. At this point of time, it also indicates a good degree of financial buffer for FNN to withstand other economic disruptions other than COVID-19 if there's any. FNN stands out in the SGD bond space because it offers a rare diversification opportunity for investors since the field is concentrated with mostly property issuers. In addition, we think FNN's bonds offer decent returns for its healthy credit metrics. We are positive on FNN's bonds, namely the 160 million, these are 3.09% March 2022 bond. The bonds are currently indicating at an asked yield to maturity of 2.05%. At a price of 101.64. Next, I'll introduce Metro Holdings. Metro Holdings is a Singapore and Indonesia-based departmental store retailer with an operating presence since the 1950s. Over time, Metro has been reducing its retail exposure while increasing its focus into real estates. Today, Metro left operation with only 2 departmental stores in Singapore, while at the meantime, it owns a variety of properties ranging from office buildings to shopping malls as seen in the picture here. We like Metro's conservative financial philosophy in the way that it approached real estate sector, starting off as a retailer. That is, the group typically partners with players that have an established presence in the property sector, jointly owning a portfolio of properties instead of leveraging up significantly as a conventional property developer does. So we also like Metro's wide international presence in having a variety of property assets such as commercial buildings, retail centers, residential projects, and mixed-use developments globally across UK, China, Singapore, Indonesia, and Australia. That also helps to offer diversification benefits. Metro displays a strong financial position. As seen here, Metro has a good track record of maintaining a net cash position. Unlike most property players, which exhibits a very highly leveraged financial profile with a high net gearing of typically more than 50%, Metro's net gearing is just a little above 10%, even as it gets increasingly involved into properties. Although at the same time, we are mindful that this may also climb higher. The good track record of keeping a healthy leverage led us to believe that Metro has a good degree of management commitment to achieving a balance between keeping a healthy balance sheet and property expansion. Metro's credit strength can also be elaborated from other perspectives. As at 31st of March 2020, all of Metro's debts are unsecured, which means that the company can help to raise secured debt arising from its 109 million of investment properties, 167 million of development properties, and 1.1 billion of interest held in joint ventures and associates that ultimately owns the many properties that it held across the various countries as shown earlier. So in addition, as seen in the chart on the right here, Metro has also 349.4 million of cash on hand, which is well enough to cover short-term debt of 145.2 million. This bond, which carries a coupon rate of 4%, is currently indicative at an ask yield to maturity of about 3% and an ask price of 101.18. So thank you all, and here's a summary of the bond ideas that we have just shared, which comprise of various industries ranging from our most favorite property sector to consumer goods. And so please feel free to check that out here at our website or scan the QR code at the top for our latest recommended bonds report. We have also shared some ideas that are outside of this report as a bonus for your attendance. So if you have any questions about them, please feel free to type that out in the Q&A box below and we'll answer them accordingly. But before that, we would like to share that we have launched our new podcast series, Yield Hunters, where we share with you our thoughts on new issues, hold discussions on the fixed income market. Right now, you'll be able to find us on Spotify and Apple iTunes. In a couple of days, we'll also be available on Google Podcast too. So you can follow us on the various social media platforms here and find us just by searching for Bondsupermart. All right, let's proceed with Q&A. Please send through your questions via the Q&A function. And Chung, I'll pass on my time to you, who will be moderating the Q&A session. Thank you.
Yeah, we'll move to Q&A now. We'll look through the questions and answers accordingly. I will try to direct to my team members and myself. Just hold on for a moment. So I have a question here about how to look at unlisted company bonds. I think I'll take the first one. So generally speaking, and taking everything else equal, we should demand a higher risk premium. And that means a higher return from unlisted issuers that don't provide regular financial filings and other regulatory disclosures, as there's typically less transparency into their operating and financial conditions. We have to look at it on a case-by-case basis, but private issuers in the Singapore dollar space are generally less transparent than issuers in the broader Asian space. And they are mostly unrated, so there's a lack of visibility into their financials, which is the main reason why research outlets like Bondsupermart usually don't cover these issuers. Just FYI, we'll be skipping most of the transactional questions because, as mentioned earlier, we are not a broker. So you can't really put transactions through Bondsupermart. We are an information and fintech solutions provider. But I'll take some generic questions like, for example, I have here, what is precious metals minimum order size? Can Ganageaswaran help with this question?
Sure. So precious metals minimum order size is USD 5,000 ringgit.
Right. Thank you, Ganageaswaran. I have another question about default rate in the US. So what's the default rate at the moment and how high it can go? If I remember correctly, the trailing 12-month default rate of a high-yield US corporate bonds was around 5.5% in July. And I'm not an expert in US bonds, but at the moment, the three rating agencies are predicting default rate to range between 7 to 12+% by next year. And just catch this related question. I think I'll answer them together, which is about default rate in Asia. For Asia, the data lags a bit. I think it was mid 2% in March, but most rating agencies expect it to rise to a high single digit by the end of this year and next year, which is still somewhat lower than the US side. Okay, I have a question here about property company, the real estate sector in China. Specifically, what is our view about the bonds issued by smaller players in China or those with lower B credit ratings? Can Jackson try to help with this?
Okay, sure. So actually, indeed, we are favored more on the first tier, or we mean the top 20 or even top 50 developers in China. But it doesn't mean that we look down on those smaller developers. And actually, we right now our investment philosophy is to look into the issuers which has the greatest yield compared to the credit risk. So right now we think that the single B graded issuers are in a quite attractive yield range compared to the double B graded issuers, mainly because since March the double B graded issuers the bond price has rebounded quickly and much stronger than the single B graded issuers. So right now the single B graded issuers are yielding at around 8 to 12% level, most of them. So right now we think this single B issuers are more favorable to invest right now. But if you talk about a wide range of single B issuers in the market, there are some huge companies such as Evergrande and Yango Group, and still we have some smaller option that we investor can think about, such as Fantasia and LV Gem, and this kind of relatively smaller and maybe a lengthy green, but because these developers may be ranking a bit after 50 or even after 100. So I think some investor may not have heard about them. So in this case, I think you should go to our website to look into our article. We have a lot of research article on this kind of small developers, and we are quite positive about them too.
Thank you, Jackson. I'm looking at a question here on a ringgit bond. LBS BINA 6.8% perp. What are our views on it? Can Ganageas help to take this?
So LBS BINA is also a bond that I cover. They have offered the highest coupon rate in terms of the ringgit space. So they are perpetual with a non-call 5. We remain positive on LBS BINA. I think recently they came out and said that they will be revising their target this year. Initially, they had a target revenue of about 1.6 billion. I think they've revised it down to 1 billion. That being said, though, they have already achieved about 780 million as of end July. I think the cautionary note of not reaching 1.6 is just to calm the investors down. That being said, I think right now the yield to maturity of 6% is actually still very fairly attractive. And given the fact that we have a fairly good amount of liquidity in the market, I don't see LBS BINA I don't see LBS BINA running into a distressed situation because they've got assets that they can that they have collateralized. They have land bank. Worst case scenario, I don't see them not being able to refinance their debt. That's our view on LBS BINA. I hope I answered your question.
Thanks, Ganageas. Okay, next question. If there are a number of bonds from a single company, what if how would the payout would be if if the company goes bankrupt or one of the bond is defaulted? Maybe Waiki, can you help to answer this?
Okay, so actually, if the company got so many bonds and one of it defaults, so it really depends on how the payout would be because it depends on TNC, like the ranking seniority of some particular bonds. So most of them are senior unsecured bonds, so it is ranking before maybe some like subordinary bonds. Yes, so it will be a big difference from different cases. Yes.
Thank you, Waiki. Next question is about Metro Holdings, the company you presented earlier. So this company has another 4.3% bond maturing in 2024. We have an audience asking, this bond is trading around 4.15% of Z spread. So does this mean there's more value vis-a-vis the 2021 bond we talked about earlier? And Metro bonds should be subjected to structural subordination as their assets are held under JVs. So how would this subordination affect bondholders' claims to assets if it comes to a worst case, which is liquidation? Can Lynda help to answer this?
Okay. Yes, we think that the spreads between the two bonds right now are quite attractive and has already priced in the decent duration premium. Metro bonds are subject to HoldCo OpCo subordination, but because most of their assets are actually parked under the JVs and they have been over the years be more conservative in terms of how they manage those assets and actually has been quite conservative towards the extent of financial support and kinds of corporate guarantees given out to their JVs and associates. So this actually give a margin of safety to us as bondholders.
Thank you, Lynda. My next question is about the Fantasia. This is a Chinese developer, small to mid-size, asking about our comments and our views on the company. I think that would fall under the expertise of Jackson. Could you please help on that, please?
Okay. So Fantasia, for some audience that may not have heard about it, it is a Chinese developer, and it is actually a third-tier developer, which if ranked by contracted sales, it ranked about 50 to 100 level in last few years. So actually, Fantasia this year is doing really good. So we, despite the property market downturn, Fantasia rose against the market. So we saw that the sales, we saw that the company is less affected by the pandemic. So its first half 2020 performance outperformed its peers. So its contracted sales is, we expect the contracted sales will remain at a high growth rate. And also on the other hand, the credit matrix. So the credit matrix are still healthy, although they slightly dropped it using the data as at end 2019. But the cash on hand is pretty sufficient to defend that a large amount of onshore bonds issuance this year. So if you talk about the bonds, so Fantasia has issued a lot of USD bonds. And when we talk about this kind of single B greater issuers, we usually adopt a strategy called the short-term high yield strategy, which means that the investor should consider the bond maybe with a tenor of 2 to 3 years or below. So do not invest into some single B greater bonds with a 5 or 6 year or above. So this, for Fantasia, we will have positive view towards its 2022 bonds. So maybe yielding at around 8 to 10%. So we think it is quite attractive.
Thank you, Jackson. Okay, so we have a gentleman here curious about the risk of 1AH versus LBS bina. All right, Ganageas?
So both of them are perpetuals, just to let everyone know what this gentleman's question is. So both of them are perpetual from the property sector. YNH is also a substantial play in the property development sector, LBS as well. Personally speaking, I have preferred LBS over YNH due to several reasons. I was not comfortable with YNH position of, while they were giving the same spread as Tropicana last year actually. Some of the security that were tied to the bond, I was not really comfortable with. Compare this with LBS Bina issue structure. I still feel the LBS Bina spread is much more attractive compared to YNH.
Thank you, Ganageas. Okay, I'll take the next question myself. I think in view of the remaining time, we will answer. We'll take 3 more questions. But please be rest assured that we'll look through all the questions. I think some of them are very good suggestions for future research articles. Or so I just received feedback that my mic is the voice wasn't that loud enough. But I was saying that due to the time remaining, we'll take 3 remaining questions, 3 more questions. But we'll be looking through all the questions, and I think some of them are very good candidates for, suggestions for our future research articles. And so the first question that I'm going to take, what is our view on Neptune Orient Lines? So for the rest of the audience who is not familiar with this company, this is previously a Singapore-listed firm, a shipping company, a container shipping specifically. Previously, a Temasek Link company and privatized in, I think, 2016 by the French shipping giant CMA CGM. So I think our last update on that company was a year ago. But the changes since then, I think there are 2 major events. One is that the company secured a Euro 1 billion loan, 75% or 70% guaranteed by the French government. So that is a huge credit positive because that solves their liquidity and operating needs for at least the next 12 to 18 months. And then another major development is that the company have overhaul in its operations recently. I think the main thing to know is that it has made NOL. Now it is actually called CMA CGM Asia Trading Private Limited to be its Asian hub. So that makes it and also rerouted some of the trading networks to focus the Asian routes under NOL. So that makes its importance to the group higher, and that makes the likelihood of financial support from the parent higher. So overall, we are still positive on this company's credit outlook. I have a question here about the impact of recent events like the US-China trade tensions on the Chinese property names. What is the expected impact on their credit outlook? Can I have Jackson to help on this?
Okay, so this is a huge question. So I would like to answer you from the top-down perspective. So macro-wise, if you talk about trade tensions, I think it will affect every industry and every sector in these two countries and even in the whole world. So when we talk about the Chinese real estate sector, sometimes we do not focus a lot on this trade tension things, because when it comes down to really the two countries, the two superpowers face off each other, we think the Chinese the real estate sector will not be affected as much as other major, for example, retail sector and some kind of frontline industry. So just like as what we said, the Chinese real estate sector right now is having a strong internal demand. And if you talk about the trade tension, yes, the economy may go down, but it may not affect a lot, because we think that the cash flow on hand for these Chinese developers right now, they are supported internally more than the other external parties. So if you talk about 10 or 20 years later, then it's very hard to predict. But if we talk about a 3 to 5 years time, we do not see this trade tension will impose a lot of pressure on these developers. So on the other hand, if you talk about the refinancing channels, about whether this US-China tension will impact the developers to refinance through overseas market. We think that it is not a very big concern, because when most of the developers refinance using offshore USD bonds, but they issue the bonds in Hong Kong Stock Exchange or Singapore Exchange. So which means we do not think that this trade tension will impose a lot of limitation to these developers to further refinance in future.
Thanks, Jackson. Okay, I will take 2 more questions. The second last is, can any of us give some color on the Hong Kong airline Cathay Pacific's bonds? Should it be looked at on the same level as SIA? I think that's a question for Lynda.
Okay, thanks. I think yes, both airlines are actually national, as we all know, national carriers of the both cities, Hong Kong and Singapore. But I think Cathay Pacific should be priced higher, meaning more yields than the Singapore airline bonds, because of the predominantly a bigger risk on international competition. Especially these days, airlines are grounded to a halt, with virtually very few airlines actually flying due to the COVID-19 impacts. But actually, we are positive on both bonds at the moment. One, because they carry a very huge strategic importance to the economy, and prior to the COVID-19 levels, their credits are also mostly doing fine and generating positive cash flows and having a decent balance sheet. For Cathay Pacific, specifically, we all know that the Hong Kong government has just lifted the airline up and given it some very big financial lifeline of some 39 billion Hong Kong dollars. That was actually about 5% more before the announcement, about 5% more than its entire market cap before the announcement. Therefore, given such a big big amount of help that is given to Cathay Pacific, we do actually see that the company will be able to survive through this very difficult period, even up to in the near term for say 1 to 2 years. So both, we like them both, but whether or not should they be evaluated on the same level as SIA, we think that there would still be some premiums given by Cathay Pacific above SIA's bonds, because of the international competitions that will still be facing even after the COVID-19 impacts.
Thank you, Lynda. Okay, last question. Another very broadly put question and quite challenging. Banks' COCO bonds, that means the AT1 or additional tier 1 instruments, or for those who are not that familiar, basically bonds that have risk or loss absorption features, or simply put, they are the junior or the subordinated bonds of banks. Are they still worth considering in this climate? I think I will have the help of our bank expert, Waiki.
Hi. So when we talk about cocoa bonds, so we all know actually it is issued by banks and it looks so safe, but actually we know that it is a perpetual bond, so which means it don't have exact maturity. So what you can take a reference will be its first call day. So probably we will think the cocoa bond will be called that call back on the first call day. So it looks quite safe, but actually what we have to think about is actually there are some risks such as loss absorption features. So because loss absorption features will really trigger when once the Tier 1 capital equity ratio fall to a certain level, like 7% or 5%, yes, in this range. So some authorities will make this a judgment. So once it triggers this level, so it will be quite troublesome. And also a part of loss absorption risk, the cocoa bond maybe they can cancel the interest payment. So this is the risk that I want to highlight. So in such environments, I don't think new investing in cocoa bond is a good option for now. Yes.
Okay, thanks, Waiki. I think I'll pass the time back to Sarah here.
Thank you, Chung. So before we go, I just wanted to share about our new podcast series, Yield Hunters. This is currently available on Spotify and Apple iTunes podcasts, and this is where we discuss new bonds in the fixed income market. You can also follow us on Facebook, Twitter, and Telegram for first-hand updates on new bond issues, credit updates, and special events. You just need to search for Bondsupermart and you'll find us. So thanks again very much for joining us tonight. We'll see you soon.